Welcome from London, where the Palace of Westminster is getting new occupants next month. Now, perhaps symbolically, you can't quite see the Houses of Parliament from the dealing rooms in the city. The river bends too much. But still, city investors desperately want to know who's going to be forming the next government. The uncertainty is radical.
I think most people in the city are either Brits with a background in first past the post or Americans. The idea that we're going to enter into a European election where the first call to Buckingham Palace probably is going to be to Ed, not to David, is probably unthinkable. The idea that even if he does get called, he's not going to have a government because there's going to be bartering, both with UKIP and the Social Democrats saying, look, we can give you a better deal, is outside people's scope. Welcome to the world of uncertainty in the UK electoral system.
Markets, of course, don't like uncertainty, and we've seen the developments in many market indicators reflecting the fact that there's concern about the potential for not only uncertainty about what government emerges, but also the process by which you get to that new government. But all of this, I think, is quite well known and probably quite well embedded in market pricing already. I think as we go through the electoral process, the market would probably express greatest concerns about the potential for some less centrist positions emerging from the political process. On the one hand, positions that may put British membership of the EU under threat if we were to see a government that was accelerating the referendum process or so forth on the one hand, or on the other hand, governments that may emerge which are dependent on support from nationalist parties that could lead to greater fiscal issues should those parties adopt a more expansionary stance and or if they seek to divert resources towards certain parts of the UK rather than taking a UK-wide perspective.
The uncertainty in the election is very high, and the reason is that we're dependent in the UK on the generosity of strangers. The large current account deficit means that if there's a disappointment from international investors, then UK equities and sterling will be hit very badly.
Now, it's not just the identity of the winner that's uncertain. There are only two plausible candidates to actually become Prime Minister. That's the incumbent Conservative David Cameron and the Labour leader Ed Miliband. And the race between them is incredibly close. So close that it's highly unlikely either of them will be able to rule on their own. How much freedom of action will the winner eventually have? Let's start by talking about Labour. They might need help from the Scottish nationalists.
I think the big concern about a minority Labour government that relied on the SNP, on Scottish nationalists, is not just that the Labour Party might find difficulty getting its programme through, but it would be reliant on a party whose vested interest would be to create trouble in Westminster and, of course, in the United Kingdom. So international investors, I think, they're not focused fully on that yet, but I think they would become rather disheartened.
I don't mind SNP. It doesn't worry me in any way whatsoever, because when a government has a small majority, it's very difficult to make sweeping changes. And of course, every new government wants to make some changes, and nobody can deny them that. But it's sweeping changes, wholesale changes at this stage of the cycle we don't want to see. And that is what really worries the market.
If we keep David Cameron, the question is whether he needs the support of the anti-European UK Independence Party.
If indeed a Conservative minority government were dependent on a sufficient number of UKIP seats, which is doubtful, but if it were the case, the idea about a 2-year or 1 to 2 year campaign, or that was focused on whether or not Britain would stay in the EU would itself be quite disruptive. If that vote happened and Britain did leave the EU, I think it would be seen as disastrous, certainly in financial markets and by international companies.
If we require a Conservative coalition to commit themselves to a referendum, that referendum uncertainty will undoubtedly impact UK equities. A lot of international investment has come through the UK on the basis of this being the best place to get entry to European products and European markets. I think if we saw that referendum risk rise, then I think international investors would be very concerned about the outcome.
I've held the view, and I've been public about holding the view, that it's important for the market to know that there is commitment to Europe, because we are the largest financial centre of Europe. I mean, it's as simple as that, and you cannot do it from the outside. That's why Zurich is declining, and we're not. So it's as simple as that. The city earns a lot of money for the United Kingdom, and it cannot afford to be on the outside of Europe. The latest poll, in fact, says there are more people who want to be in than out. If we have a full outing, as we did with the Scottish referendum, of the real effects of not being out of Europe, and we go beyond the rather emotive issue of there are lots of Romanians and Poles who've come over here, I think you'd have a more positive response from the population.
So, there are risks in almost every direction. Most investors would probably be happier with a centre-right government, but if that comes packaged with the risk of European exit, that's a big problem for them. And there's a further level of uncertainty. Is it possible markets would actually be more comfortable with a government that can't do everything it wants?
I think the outcomes that are most worrying to the markets are outright victories by either major party. On the Labour side, we're worried about big fiscal issues, despite them trying to calm us down. On the Conservative side, we worry about the in-out vote on a referendum, which would be damaging to sterling. I think a minority government that can't make sweeping changes is the best possible outcome in the UK election, for sterling at least.
There's another crucial question. Is it in the price? Of course, the FTSE 100 has been making all-time highs recently. That might suggest that there isn't much election uncertainty in the market. But, of course, the FTSE 100 stocks are mostly very international. If you take into account the currency, and if you compare with other markets around the world, you can see that the election is already having an effect.
UK equities, although the valuations may look high, relative to other markets, they're close to a 35-year low. And that, I think, is going to give them some protection. The other protection that they have is that almost 70% of their earnings are foreign denominated. So if sterling gets hit, then actually, at some point, international investors will say, well, let's buy some of those international earnings out of the UK because they are just very cheap.
I think there's at least a 6% discount. If you look at interest rate differentials, the difference in interest rates between the US and the UK and the currency tracks beautifully. At the moment, it's pointing to cable, sterling against the dollar, being at around 155. But as you know, we're well below that. That is the election discount.
If you want to try to make money out of this, then good luck. There is a decent chance of a good buying opportunity sometime after the election. There's so much uncertainty that once this is resolved, people in the city are going to feel mighty relieved. But I suspect it would be foolhardy to try to take a position before the election. People in the city are just too cautious, and it's simply too unclear exactly who is going to be occupying the Palace of Westminster. John Authers, Financial Times, London.